Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a business valuation expert focused on strategic planning and exit planning in St. Louis, Missouri. Today, we are talking ERC tax credit information for advisors and business owners with Catherine Tindall. She's a CPA in California, specializing in tax credits, and is also a partner with Dominion Enterprise Services. She's combined proprietary technology with professional expertise with her CPA team and is able to offer a fast turnaround time on credit claims while maintaining a high degree of precision. It's her mission to help business owners in key industries affected by COVID shutdowns, such as restaurants, construction, and hospitality, to take advantage of the employee retention credit before it begins to expire in the spring of 2024. Welcome, Catherine. How are you?
I'm doing well. How are you? Thanks for having me.
One of the other things that I think I would be a little concerned about if I'm going down this path is the IRS and the
Yeah.
audit. And so
Yep.
do you think that the IRS is going to audit companies who take this ERC credit or at a certain level, like
Yep.
can you already kind of envision what's they're going to start looking at? Because I think creating that audit file at the beginning is very important, just so that you know how you proved it out. Like we do that a lot in the
Yep.
valuation. Like,
Yes.
how are you going to prove this out when you get to court?
Yep.
And so, but do you think that the IRS is going to target like thresholds or types of things? What do
hmm
you think is going to happen?
Yeah. What I think is going to happen, I think that we don't have these formal guidelines yet from them. But what I think will happen is that claims that are in a certain size will be selected for audit.
Hmm.
I think claims that don't make sense on the face of them will be selected for audit. So, for instance, if you've got, a construction company in Florida that had increasing revenues for tax year 20 and 21, claiming the credit for all quarters, that doesn't make sense on the face of it. So,
Mhm.
they're going to look for things that don't make sense on the face of it. Now, if you're a restaurant in New York City and you're claiming for all quarters, that's a lot more likely. So, I would imagine that they're going to take an audit program like that, where they're going to look at cases that just, kind of statistically don't make sense and go after those. And then I think the other piece that they're going to do is they're going to select providers for audit. So where we're seeing, they've already given us a special pathway for whistleblower claims against bad providers. I think there's going to be a massive enforcement effort on a provider level, where they're going to just audit the whole provider, and then probably DOJ activity, for some of the negligence that's going on out there in the field. So I think that's how they're going to approach it. But we won't know until we get there. And, I think for a lot of the smaller claims, it's probably less likely that they're going to be audited, but we just really can't speak to that. So that's why I just treat every case that comes across my desk as if the agent's going to be contacting me, the minute it goes in the mail. Just because you have to, assume that that's going to be the case. And then, hopefully it won't be every single one gets audited, but it is going to be a highly enforced program just because of the dollar figures involved, because of the bad actor, the amount of bad claims that are being filed. The IRS has issued warnings to employers to watch out for bad providers. So they have their eye on it, and it's coming. It's just a matter of time, because they have a couple of years after the filings are done for a statute of limitations to come back. So, even if you file, get your checks, everything seems hunky-dory for a year, they can show up well after the fact, after the money's been spent even, and initiate an audit. So that's what we're anticipating.
Well, and I think the nuances of it, because there are some of these like kind of uniquenesses that create the eligibility and things like that, you're going to have practitioners that are just like, oh, 10 times 26,000, and you're going to have people that are kind
Yes.
of just doing this on a very easy, I always laugh when people say, oh, have you ever had an estate valuation go through an IRS audit? I was like, no. And they're like, well, how? And I'm like, because I base the valuation on reasonable assumptions. And so what I'm hearing you say is like, I'm basing the tax credit on our research, on our understanding, on your company. And here's the backup for that decision of what to put on the tax return. And if the the IRS disagrees with us, they're going to come back, but we're going to have our reasoning. Yeah. And it's probably going to have, you know, like it's not going to be as aggressive, maybe as somebody who's just taking 26,000 multiplied by 10 employees and going for the credit, right?
Yeah, because that's what I see a lot of people do is, or, you know, I'm dealing with trying to clean up messes from some of these situations where people will just say, oh, you know, you business owner, did you have disruptions during the pandemic? And the business owner says, oh yeah, it was the whole pandemic. And they say, okay, great. And then you qualify for the whole thing, you know, and they were just basing it on a client attestation instead of the actual legwork and, you know, following the rules from the IRS for substantiating documentation. And the client doesn't realize that that's what's happened. A lot of times the outside tax practitioner doesn't realize that's happened. You know, I was on a phone call earlier today with another practitioner who his client was working with an outside law firm, and he was concerned because it was going to be a very large case. And I said, well, did they give you copies of the government orders? Did you ask for them? And he was like, no, they didn't. And I was like, well, ask for it, see what they've got. Because if they've got that and they're doing this and that and the other, you know, it's probably fine. But people just don't realize, you know, what goes into the background of these. It's not as simple as saying, okay, you know, I paid, you know, Sally, Susie and Sally and Jimmy X amount in wages. I'm going to times that by 70% and there's my credit. You know, it's not as simple as that. And a lot of providers don't realize all of these rules and, you know, the nuances, and they don't realize that there's amended income tax returns required and amended payroll tax returns required. They just don't realize all that goes into it. Now, and the business owner doesn't either. So it's,
what did you just ask if we had the legal something?
Oh, the substantiating documentation.
Well, no, but when you said specifically, did they have the legal, like if you ask a practitioner some of these things and they look at you like deers in the headlight, like I did, they don't know. That's a problem.
Yeah. It's like, what's the copy of the government order? Like, it's going to be specifically Governor so-and-so's order, you know, 16 dated May 15th, 2020. Like, is that what you're using? Like, what are you using for a government order? Because that's what it hinges on for a lot of, you know, eligibility for people is government orders. And so if you don't have the physical order, and then also showing like, okay, it's paragraph this, subsection this, where it references this business type of, you know, non-essential retail, capacity restriction 40%. Like if you don't have that, you know, the work hasn't been done. And a lot of people don't realize that.